in greater detail. Joining us here in studio to break down this decision is Frances Donald, Chief Economist at Manulife Investment Management. Frances, thanks as always for joining us.
Happy to be here.
So those are some of the headline numbers and commentary from the Bank of Canada. What's your initial reaction?
So it sounds like Governor Poloz is telling us we're going to keep those rate cut hopes alive. We're not sure that we're going to move ahead with lowering the interest rate over time, but we want to give you the roadmap that would lead us to potentially doing that. And that's really critical at this stage. He needs to keep financial conditions fairly easy. He needs to keep the Canadian dollar soft. He needs to keep the global economy and Canadian watchers aware of the fact that if the economy does deteriorate, he is willing to step in. The big challenge, of course, being when I say Governor Poloz will step in, by the time we get to that point, probably in the second half of 2020, it won't be Governor Poloz anymore. It'll be someone else at the helm, and that'll be a really critical component to those rate cut calls in 2020.
Yeah, Stephen Poloz in his final months as governor, set to leave in June, so I guess we'll start asking questions about who's going to be replacing him. But I do want to just get to another key quote that they shared, to your point there, about whether or not the door has been left open to a rate cut. In determining the path for future rates, they will be, quote, watching closely to see if the recent slowdown in growth is more persistent than forecast. What would you be watching for, do you think, in terms of the economy to determine if that ultimately plays out?
So they've consistently told us that they want to make sure that the global manufacturing recession, that global uncertainty didn't bleed from manufacturing into services. What does that mean? It means they want to make sure that that consumer remains protected. So number one for me is the jobs data. We know jobs did fantastic in 2019, but the momentum was decelerating. Does that deceleration in momentum continue through to 2020? That'll be number one. And number two, keep a very close eye on business investment. There's a lot of business investment data that tells us this is a weak component of the economy. The Bank of Canada has consistently said, don't worry, it's going to come back. But we haven't seen enough strong evidence that we're heading towards that V-shaped recovery yet. I think they're probably getting a little bit worried from the headlines they're reading to me.
All right, and as the Bank of Canada keeps rates unchanged, to your point about business investment, they've tweaked their basically growth picture as we wrapped up 2019. They projected fourth quarter annualized growth in the end of 2019 of 0.3%. And they're calling for 1.3% for the first quarter of 2020. So they're revising their growth estimates, not just for the fourth quarter, which was expected, but also for the first quarter on some of these wild cards.
1.3, that seems to be the magic number. That's what we had for Q3 of last year. That was their forecast for Q4, now for Q1. But bigger picture, what's that messaging? 1.3, that's pretty doldrums growth. That's muddle through growth. That's growth that is not really consistent with any form of hiking. It suggests to me that they're continuously focused on the downside risks. And when you get to 1.3%, you're getting a lot closer to zero than you are up towards the upper end of potential growth numbers. So I'd be watching those forecasts very closely. To me, that suggests they're a little bit more pessimistic on the outlook.
All right. Our own Greg Bunnell was in the lockup in Ottawa, and he joins us now with more on this Bank of Canada decision, keeping rates unchanged and sharing plenty, Greg, on where it sees the economy potentially heading. What was your takeaway from what the Bank of Canada had to say?
Still feels like they're trying to put that tone out there that don't worry, everything's all right. But as they listed the bad near the end of 2019, it definitely started to add up. They're talking about near-term economic weakness, as you and I believe that was Frances Donald were discussing. Here's the list. Exports fell into the end of 2019. Business investment softened. Job creation slowed. Consumer confidence and spending got soft as well. So even though the tone from the bank is lately is don't worry, it's been transitory, that is a lot of bad to heap up just on one announcement where you've held rates steady. If there was a good in this, as they highlight this economy, obviously the housing markets have rebounded. They're resurgent in the Toronto area. Now, a lot of people I talk about say we're seeing a near-term boost in housing, but they're not predicting a runaway market again, that'll start to ease off as well. And of course, they say when it comes to that weakness through the end of last year, there were special factors. Of course, we had the CN rail strike, we had the Keystone outage as well. What really sort of piqued my interest as I went through this is the fact that they highlighted the consumer again. We know after a decade of indebtedness that the consumer was carrying this economy on their backs, and indeed they are the single largest contributor in terms of percentage points to GDP forecast for this year as well. Here's the mixed in that. The savings rate is actually ticking higher, and they expect it to tick higher as well. That's not necessarily a bad thing. If you have highly indebted households, it's a good thing if they have a bit of a cushion put aside in savings to weather any bad economic events. Of course, that would take the strain off the financial system. But if not the consumer propping up the economy, then who's it going to be? You want to hand off that ball, don't you? Governor Poloz will be coming to the end of his term in June. He started off his tenure talking about this transfer from the consumer carrying the economy to the manufacturers, to the exporters. Of course, the crash in crude prices, the trade wars and the tensions there definitely put that on the side damper. They're still optimistic in this report. As I go through the monetary policy report, they talk about oil and gas getting back on its feet in the coming years, exporters finding their way again. So it's a bit of that perfect scenario. Don't count the consumer out. They're not counting the consumer out, even though they've been a bit soft. And the exporters will pick up. Of course, those are all forecasts. And this bank, particularly under Governor Poloz, has been hoping the exporters will start taking the ball and running with it for years now.
Francis Donald, let's pick up on that theme of the Canadian consumer. And it sounds like the Bank of Canada anticipates that households are going to be doing some spending over the next couple of years. We have talked about what's happening in Ottawa with fiscal policy and tax cuts, which seems to be one of the other factors I would imagine that might put a little cash in a consumer's pocket to spend.
This is the problem. We're always looking at the consumer from a cyclical perspective. What have they done in the last 3 months? What are they going to do in the next 3 months? And then also from a structural perspective, what does their 5-year trajectory look like? It is really difficult to be bullish and positive over the consumer over a 3 to 5 year horizon. They're paying the most amount. We as households and Canadians have never paid this amount towards the debt out of our income every single month. We pay $15 of every $100 that we take home towards the interest and principal on our debt. That does not leave a lot of room for other forms of spending. The savings rate might be ticking up a little bit, but it's still very low at 3.2%. That's not a lot of room for a shock. Now, as long as job growth is strong and the momentum continues, we don't have to worry too much about the next 3 months. But it's getting increasingly difficult to say that this consumer can carry us. So what the Bank of Canada has been looking for is, we're losing one engine of growth. Where does the next one come from? It has to come from the private sector, from the business sector. But until we get energy back online, until we diversify away from finance, insurance, and real estate, that picture is looking more glum. When you look out over the next 1 year, it sounds like what the Bank of Canada is flagging is a lot of concern about that transfer from the consumer towards the private sector. So I wouldn't be surprised if the big decider factor on whether or not they cut this year is whether they see that other engines of growth come back online.
Well,